If you're a law firm owner and you think your trust account is fine, you need to hear this video because I've worked with firms doing 1 million, 2 million, even 4 million and above in revenue. And they were one reconciliation away from serious compliance issues, not because they were doing anything intentionally wrong, but because they didn't fully understand how trust accounting works. And today I'm going to walk you through that. So, what trust accounting really is, where firms get it wrong, and how to fix it before it becomes a problem. So, let's simplify this. Trust accounting is not your money, it is client money that you are holding temporarily. And that means you cannot treat it like revenue, you cannot spend it, you cannot borrow from it, and you must always be able to prove exactly who that money belongs to the penny. So think of it like this. If your operating account is your wallet, your trust account is the locked safe that belongs to the clients. So you are just the person holding the key to the safe. So let's talk about what's called a three-way reconciliation. This is where most law firms break down. Trust accounting requires something called a three-way reconciliation. That means three numbers must always match. So the bank balance needs to reconcile to your book balance, which is your IOLTA checking account on your balance sheet. And the IOLTA balance needs to match the client ledger totals. Okay. Each individual client add up their balances. There's got to be a total, tie that back to your IOLTA checking account balance. If those three numbers do not match to the penny, something's wrong. And here's the issue. Most law firms are only looking at one or two of these numbers. They might check the bank or glance at QuickBooks, but they're not tying all three numbers together and documenting what they're looking at. And that's where risk starts. So let me walk you through what I see frequently, the most common mistakes. One is treating trust money like revenue too early. A client pays a $5,000 retainer and it just gets recorded into income immediately. And that's incorrect. It needs to sit in the trust until it is earned. And only when you bill against it does the money move into your operating or your revenue accounts. The second is not keeping detailed client level ledgers. So I asked this question: show me how much money in the trust belongs to each client. And the answer is, well, we don't necessarily track it that way. That's a major issue. So you must be able to say, for example, client A has $2,000, client B has $500, client C has 7,500 at any time of the day, on any day of the year. So here's the third common issue I see: using trust accounts to float cash. Now, I don't see this frequently, but when I do, this one makes me nervous every time. A firm is short on cash and they think, I'll just use this money and I'll fix it later. And this is how firms end up in disciplinary situations. Even if it's temporary, it's still a violation. So here's the fourth mistake I see: not doing monthly reconciliations. Now, I'll put a little asterisk here that there are a handful of states that allow you to reconcile your trust account on a quarterly basis. So look with your state bar what the ethics rules are on this. But I highly recommend monthly because every bank I've worked with generates a monthly bank statement. It makes it so much easier to do these on a monthly basis. But I have seen firms reconcile once a year. Some never do it properly at all. But trust accounting needs to be reconciled. Again, I recommend monthly, even if you are in a jurisdiction that allows quarterly. The longer time period, the harder it is to find mistakes and get them corrected. And then the fifth mistake I see is mixing operating and trust activity. And this shows up as paying expenses directly from the trust. And let me clarify, if you're paying case expenses from the trust and your client is aware that that's what the money in the trust is being used for, you're okay. But I'm talking about paying rent for the firm's office. That's a problem. Um, Depositing earned fees back into the trust, meaning you deposited money that was meant to be held in trust, deposit into your operating account, and then decided to move it back into, move it over into the trust. Now, I see this, I used to see this frequently where there would be confusion with checks. Now that a lot of firms are moving into credit card payments, if you don't have a service set up specifically for law firms and trust accounting like LawPay, this is why there's a premium that you pay a monthly fee for LawPay, because it is set up to allow clients to pay a retainer with a credit card, and that money that's a retainer goes directly into the trust. Okay. If you use a different processor that's not set up, for example, Stripe, and I'm not trying to pick on Stripe, they're just not set up for the legal industry. But if you use Stripe or even PayPal or Venmo, that money just by nature ends up going into the operating account for the firm. And then you have to move it into the trust. That's a no-no. And then moving money of any time between the trust, in or out of the trust without proper tracking. And this creates confusion very quickly. So let me give you a real scenario. A firm I worked with, they were doing about $1.5 million in revenue, and they told me our trust account's clean. So I looked into it. The bank balance was 120,000. And when we added up the client ledgers, it only supported 95,000. There was a $25,000 difference. And they had no idea where this came from. But here's what happened. It turned out that old retainers were not cleared properly in the books. Fees were recorded incorrectly, and some funds were moved without documentation. Now, let me assure you, they were not trying to do anything wrong, but they were completely exposed. So what does good look like? Well, here is what a properly managed trust system looks like. First, clear separation. Trust account completely separate from the operating account, and there's no crossover activity. Now, again, there would be one transfer whenever you earn money from the trust. So retainer held in the trust, you bill, it's earned. Now you can transfer trust to operating. That's the only time that's acceptable. 2, you want a clean workflow. Retainers go directly into the trust. Do not pass go, do not collect $200. And invoices generated. That gives you the green light to now take money from the trust because you've earned the money on the invoice, and funds are now transferred from the trust to the operating account. 3, you want to do your 3-way reconciliation. Every month, document it. There are literally very specific things that have to be included on it. It has to be documented. It can't be, I looked at it. That can't be, there's no proof that you looked at it. That's why you have to document your 3-way reconciliation. Oh, and it has to be reviewed. Okay. Check with your state bar, with your, with your jurisdiction, with your specific rules. They all vary slightly. God forbid we can get every jurisdiction on board with this one, but the majority of them are about 95% the same. So just get it done every month, document the reconciliation, and get it reviewed by somebody who did not prepare it. 4th, you want client level visibility. You want to be able to answer this question at any time. How much money of this trust in your IOLTA account belongs to each client? And 5, I highly, highly recommend proper software or some type of a system. Now, I do have on my website, I have available for free. You can download an Excel file that you can fill out once a month to complete your reconciliation, your 3-way trust reconciliation. But I really don't recommend, that is not my go-to solution. That is like plan Z when everything else fails. But this is where tools like MyCase, Clio, and TrustBooks or others can help, but only if they're set up correctly. And I get it, it's an additional fee, but seriously, to be able to sleep at night knowing that it's all good is well worth the money spent. Software does not fix bad processes, though. So why does all of this matter more than you think? Well, trust accounting is not just bookkeeping. It's compliance. It's ethics. Literally, your license is on the line. And what I see most often is not intentional wrongdoing. In fact, I have seen a lot of problems with trust accounts. Never, ever have I ever seen something intentional. Okay. It's been accidental anytime or misguided, but never intentional. It's a lack of clarity. Okay. Firms are growing, revenue's increasing, but the systems didn't grow with the firm as it's growing. And that's where risk shows up. So if you're not 100% in your trust accounting, that is something to pay attention to right now, because firms that get into trouble are usually the ones who thought everything was fine. If this sounds familiar, you're not alone, but it's 100% fixable. If you found this video helpful, make sure you subscribe, because I break down financial concepts like this in a way that helps you actually run your firm better.